damn phones. Babylons can't crack the code.
Welcome to B-MoneyTrading. This video is going to be about the PDT rule as well as the top 10 mistakes that the beginner trader or a new trader makes. So starting off, we have it pulled up here, the PDT rule, and exactly what is it? Well, it stands for Pattern Day Trade Rule, also known as PDT, is in place to protect the beginner trader or beginner traders. Now, I don't know how really, as the more you start to trade, you'll understand why. I don't know if that's necessarily true about protecting the beginner traders, but moving on, it is important to know this rule. If you have less than 25,000 in your bank account or trading account and you're an active trader, now it's basically telling you that because what happens is they came up with a rule saying you can only buy and sell the same stock within the same day 3 times in a 5-day period, unless you have $25,000 or more in your bank account. And I'm not sure exactly when this went into effect. I think it was either when the .com bubble burst or the housing market burst. And I believe basically what it's for is to keep the volatility somewhat minimal in the stock market. So basically what they're trying to tell you is, we'll do a quick example. So say on Monday the 5th, you buy AMD and you sell it all in the same day. That's one pattern day trade. You have 3 of those. Now if you bought AMD on the 5th and held it overnight till the 6th and sold it, that wouldn't count as a pattern day trade because you didn't sell it in the same day. Basically, if you buy any stock, no matter what it is, whatever stock you buy, if you buy it and you sell it the same day that you bought it, that's one pattern day trade. And so say you did that on AMD on the 5th, and so you bought 500 shares and then sold 500. Or even if you bought 500 shares and only sold 400, that would still count as a pattern day trade because you did, even though you didn't sell all the shares that you had, it would still count as a pattern day trade. Now if you went and sold it again, the last 100 on the same day, say you bought 500, and it doesn't matter, you buy all you want, you buy 100, 200, and different increments. But as soon as you start selling it, that's when it starts counting as a pattern day trade. So say you bought 500, or say you bought 200, and then you bought 200 more, and then you bought 100 more. So now you have 3 buying, you did 3 buys. First one was for 200, second one's for 200, and then the third one's for 100. So now you have 500 shares, and you decide that you're only going to sell half of them and take profit and keep the other half. So you sell 250. That's one pattern day trade. So then you go Tuesday and you sell the other half. Then it's not a pattern day trade because it's a different day. So you have one pattern day trade on Monday. So you do it again on Tuesday. You buy USO, United States Oil, and you buy however many shares, 300 shares, and you sell 300 shares on the same day. That's another pattern day trade. So now you have 2 pattern day trades for this week so far. So now you only have 1 more pattern day trade. So say on Thursday you decide you're gonna just do a quick scalp on Facebook or whatever and buy a few shares and then sell it. So you buy like 20 shares of Facebook, hold it for a minute, 2 minutes, doesn't really matter. As long as you sell it within the same day, it's gonna count as a pattern day trade. And so then you sell it. Now you have one for the 5th, one for the 7th, and one for the 8th. So now the next time you can do a pattern day trade isn't going to be until the 12th, and you're only going to have one available because that's when you did your first one. And so say you don't decide to use it, and so you don't use it then, but you use it on the 13th. So now you have a pattern day trade there. Now your next one is not going to be available until the 14th because the second one you did was on the 7th. So now you got another one available. So now you have one pattern day trade you just did. You got another one now that's available, and so the 14th comes and you decide you're going to go ahead and do it on the 14th, another one, and so you do another pattern day trade on the 14th. Well, now your next one's not gonna be available because the only other one you'll have available is gonna be on the 15th because it'll be, you know, a week. The last time you did a pattern day trade, your third one that you did during this week was on the 8th. So now you have another one available. So you go ahead and you do it on the 15th. So now you've done, initially you did a pattern day trade here, you did another one here and another one here. So then the next week came and you did one here. You didn't do one here, but you had one available because the last time you did it was on the 5th. So you have one available here. But instead you held it and you used it on the 13th. So now you got one here, and then the second one you did on the 14th because it came available, because the second one that you did in this week was on the 7th. So now you have one available here. And so you start to catch the drift. So then your third pattern day trade you have available is going to be on Thursday because that's when you did it here. So now on the next week, because you did one here, here, and here, you're not going to have another one available until the 20th. And then your second one will be available on the 21st, and your third one will be available on the 22nd. And so basically it limits you on what you can do, you know, because you can easily do 3 pattern day trades in the same day. And so you do 3 pattern day trades on, say, the 5th, all 3 of them, you're going to have to wait until the 12th before you can do any, because you did them all 3 on the 5th, and that's the most you get for 1 week. So now you're going to have to wait 5 days, business days, to get them available. And so say you did them all on the 5th, well, now you know, made some money, whatever, and you're excited. So now on the 6th, you buy a stock, and because you're new and inexperienced, you go in way too big. You bought way too many shares. You bought 1,000 shares of some penny stock, like Tops or DICX or whatever, and it starts tanking. And so now you're down a shitload of money, but you can't sell it because you've already done your 3 pattern day trades here. If you do it here, it's going to be a 4th one, and you're going to get a restriction, a 9-day restriction. I think they let you get away with it once, doing once. Don't hold me to that though, because I've never broken it. I've seen people on social media that have broken it, and you can only take what you see on social media with a grain of salt. That's one of the things that is one of the common mistakes that new traders make. And so you have to basically take that loss and just hold on to it until the 7th and then sell it. Because if you don't and you break it, then you're going to be restricted for 90 days before you can do any, I'm not sure if it's any trading or just any pattern day days trading, but either way there's going to be some kind of restriction, and nobody likes to be restricted. It already stinks bad enough that you're being restricted to 3 pattern day trades per week. Now on top of that, you've gotten another restriction put on you. And so it says to protect, like I was saying, I didn't know about that. It says to protect the beginner traders. How is that protecting them if they're stuck in this trade? Because if they, and so basically, say they went way too big and they started with a $20,000 account. It was their money they've been saving since, you know, they started working in high school up till now when they just started college, and that's all their savings, and now they're having to just watch it bleed, you know, and hopefully it's not too bad. That or do another pattern day trade and be restricted. And so then you have to weigh the 2 evils. Which one's the worst of the 2 evils, you know? And so as far as protecting, that's in my belief a bunch of crap. But anyhow, so that is one of the things that people run to with the pattern day trade rule. And so a lot of new traders, one of the biggest mistakes they make is trying to find ways around it. And from my experience, because I try to do the same thing and it ended up costing me more money in the long run, rather than if I just would have looked at all the rules within the broker I was using, which a lot of people knew start with Robinhood, because the commissions are free, so it gives you a better advantage as far as being able to be profitable. The platform's not set up for pattern day trading. It takes way too long to execute. Now, let me take that back. It's not set up for scalping. It's not set up to jump in, buy 500 shares real quick within a second or two, and then turn around and sell it within 30 seconds and make 10 cents off 500 shares or 1,000 shares. It takes way too long to process your orders and to get them filled. And so if your strategy or technique in trading is going to be scalping, then Robinhood's not going to be the platform for you. And so a lot of people will then go to a broker outside the US that has high commissions. And from my experience, like new traders, I think, okay, this is what's holding me back, or this is what's holding me back. Now, if you're serious about trading, then you're gonna have to learn some patience, and that's another one of the top 10 mistakes, And so, basically, what we'll do is we'll just go ahead and start off with the top 10 mistakes list. All right. So we know what the pattern day trading rule is now. And unless you have over $25,000, which a lot of people starting new in trading, they're not willing. Well, from my experience, I wasn't that trusting of whatever broker I was going to use to put in 25,000 into my account. I was hesitant, and so I just wasn't willing to go there. And then on top of that, a lot of people don't have that kind of money to start off with, or even willing to mess with that kind of money. The average person, here in the United States. So basically, so you're a new trader, you open up a Robinhood account. Now you learn that you can't pattern day trade, so you're trying to figure out a way to still make money. And so you decide you're just going to do your pattern day trades. You're going to do your 3, and then after that you'll, throw some Hail Marys, because basically, once have used that 3rd pattern day trade, you get any more trades that you can't get out of because you're going to be restricted, then, unless it's part of your strategy. Now, if your strategy is swing trading, then that's a totally different deal. But then again, if your strategy is swing trading, then you're probably not using any, or if you do use pattern day trade, it's not going to be 3, You're going to be doing some longer holds. So anyhow, with that said, we're going to move on to the top 10 mistakes new traders make. So they open up the Robinhood account like we're talking about. They found out about the PDT rule. They don't have a lot of money, so they see they can buy either, 10 shares of, 10 shares of, say, AMD or something like that. I'm just going to keep using AMD because it's an easier reference right now. Or they can buy, 500 shares or 1,000 shares of TOPS or DCIX or some other, IGC, which is now like IGCC or whatever. And so they go ahead and they say, well, I'd rather have more of something than to have something that's really good. I see these people post up, these penny stock traders making all this money, and so that's what I'm gonna do. And so they go and they jump into these penny stocks and try and pattern day trade them. And that's the next top 10 mistakes that new traders make, is they have unrealistic expectations. They read a book or something over the weekend, or even take a class that's 2 months or 3 months long or whatever online, and they think that they're just going to hop in the market and all of a sudden start raking in the money. So that covers unrealistic expectations. My number 3 top 10 mistake is that they read a book over the weekend and expect to be masters on Monday, which is just crazy, insane thinking, to think that you can just read a book and have mastered something just by reading a book. When you got people that this is their profession, that have billions and billions of dollars invested into to trading, in stocks and equipment and data and hardware and technology, scanners, algorithms, high frequency trading, all these things, and you're just gonna hop in and just start banking. You learn real quick. You see the money there and you see people making it, but when it comes your turn to try to make it, it's a lot tougher than you think to consistently make it. So with that said, they have the small account. They're buying crappy stocks that either have no volume or they do have a volume, but they're moving like a tenth of a penny is what they're trading for. And so they bought a crap load of shares because it's only, tenths of a penny per share, fractions of pennies per share. And then when they go to sell it, they can't get rid of all their stock because there's no buyer there that's willing to pay that for it. And so they end up taking a loss on it, trying to get out of the trade, and so they start, picking quantity over quality. They have unrealistic expectations. They think because they've read a book or took some class that they know what they're doing now, and they get into the market not having a strategy or an edge. A strategy as far as stock's gonna, I'm looking in here to trade either this pattern, I'm gonna trade, bull flags, and that's the only pattern I'm gonna trade. And if it drops, below, I'm gonna, go at it with, 100 shares at a time. And if it drops below, 15 cents from what I bought in at, then I'm gonna go ahead and get out. And if, my target is X amount of money, and they have a plan put together or an edge, they know something about a company that not a lot of people know or have researched, or something that's coming up, that they're supposed to be releasing something or some good news or some conference, and they have something that, basically, I'll put it this way. I was talking with my coworker last night, and she was talking about she was going to bet another coworker on this football game, $200, and he backed out. He said, "No, I'm not going to do it." He said he would, but then at the last minute, he backed out of it. And then 2 days later, he calls her up and says, "Hey, you still want to do that bet?" And she's like, "I'll do $50, but I'm not going to do the 200 now." And so they end up betting on it, and she loses. And I say, well, whenever you try and place a bet and someone doesn't want to take it, but then they come back 2 days later and are wanting to take the bet, they must know something that you don't know, and so you should be cautious on taking the bet. Now, I don't know if he knew something or not, or if it was just a 50-50 chance, and he just happened to get lucky. But it's the same deal with stocks. Some people treat it as gambling and just buy in, and they say, I got 50% chance to go up, 50% chance it's gonna go down, and being new, you have no idea the complexity that can be involved in trading. I try and keep it simplistic, but there are a lot of things to learn before you get off and running and trying to make the big bucks. So with that said, the next big issue that I have is they listen to others on social media. I can't tell you how many times I get on Facebook in these trading groups, and people say, "Oh, I bought these options," and and these are like new traders that bought like $2,000 worth of options or $4,000 worth of options, and they're down like $1,200, and they're like, "I don't know what to do. How do I get out of this?" And I'm just like, are you serious? Like, I don't know who the hell would get into something not knowing how to get out of it. Like, if I didn't know, I'd make sure I knew how to get out of something before I got in it, And so they, end up losing this money, or they listen to others to where people say, "Oh, this is going down," or "It's going to the moon. It's not too late. Today's the last day to jump in this stock." They're trying to pump it up because they're already in it, and they're holding a bag. They've already taken, they're down on it, and they're trying to get people in it so that it'll go up and they can get out, and now you can have the bag. And so, a lot of that, if anybody says like it's going to the moon, that should tell you right there, stay away from it. If people are making all this money on this stock, and they're like, hop in, it's, you know, made this much today on it or whatever, and it's just ripping and it's on a run. Like, usually if you're finding out about it on social media, you're too late. Now, if you're trading and you happen to be scanning the stock and it hits your scanner and says, you know, it's made this much gain and it meets the criteria to hit on your scanner, then yeah, you may have a, you know, a good chance at taking something on it. But, you know, once you hear it on social media or on the news, you've missed the train. You know, that's what they call chasing the stock. One of the famous traders always says, if you chase, you die. You chase, you die. And he always remembers that. If you chase, you die. There might be, you know, you might get lucky once out of 10 and make some money on it, but the other 9 times you're going to lose money. That's not a good strategy. You know, you have to look at the long term, the long span of your trading career, not just today or this minute or this hour. And that's a lot of mistakes that new traders make, is they look at, I was successful today, I got this. You know, they may even have a successful week and think, okay, I'm good to go now, I know it all, and start giving out advice on these trading groups or whatever. You know, if you need help, just, you know, message me or whatever. You know, and 1 week, there's such thing as beginner's luck. In 1 week, that is not a long enough time span. I've had runs for 4 to 6 weeks where I was making $400 to $600 in a week, doing a little bit of swing and a little bit of day trading. And, you know, I would say after that, you know, 5th, 6th week, 7th week, however, you know, a lot of times it would run anywhere from 4 to 6 weeks. And so say that 7th week, I would take a loss, and it'd be a pretty hefty loss, not too bad, but then another one follow after that. And I'll tell you, within a week, I'll have given back all those gains that I'd made just in the past month or month and a half in just 1 week. So you can't you're not going to know if you're a successful trader until, say, you start trading on January 2nd or 3rd or whatever, and then you get to the end of the year and you look back at your year and see how you've done, and only then will you know exactly how successful you are. And a lot of traders think, oh, I made money this week, I'm good, I got this down, I know what I'm doing. It's going to take time to really see exactly how good you are and how much you've progressed. Another big mistake that traders make is they start too big. They start off and they dump in, you know, they have $7,000 in their savings account, and so they said, well, I'm gonna dump in $5,000 because I need to buy a lot, you know, of something, and I'm gonna flip it, you know, and then within a month I'm gonna have doubled my money. Unrealistic expectations once again. And so they put in this $5,000, and the next thing you know, they're taking, you know, $300, $400 hits each day. So about within a week to 2 weeks, they've already lost half of their account. You know, I did a video on the 90, 90, and 90 rule, and basically what that is statistics show that 90% of traders will lose 90% of their account within the first 90 days of trading. So that's a big, you know, portion of people. So, you know, for me, I'm gonna be honest with you, I made that mistake. I went in too big when I started. You know, I'd taken a course, I thought, you know, I got this, and I got my ass handed to me really quick in the market. It let me know that it didn't care how much I'd studied, it didn't care what I thought I knew. The market does what it does, and the market is never wrong. It is very efficient, and it decides. And so with that, they start too big, then they take big losses. So then they start thinking, well, maybe stocks aren't my deal. Maybe I need to switch to Forex or options. So then they start switching to that, and they start losing their ass off. So then they switch to something else and start losing it. And so it's like, try to be the master of one thing, you know, before you try to be a jack of all trades. And so for me, you know, and I've dabbled in different stuff here and there, you know, and they'll switch from day trading to swing trading, back to day trading, to options, day trading options, swing trading options, all these different things. And it's just not, you're not making any progress. You can only focus on one thing at a time to actually continue to progress at it. You try and focus on 5 different things. It's going to take you forever to learn those 5 different things if you're trying to learn them all at once. So with that said, stay focused and looking what they could make and not what they could lose. Not learning about risk management, that would be the number 8. Number 8 of the top 10 biggest mistakes that new traders make is they're constantly looking at what they could make and not what they're risking to make it. They say, yeah, I know about the risk reward ratio. You want 2 to 1 or 3 to 1, but no less than 2 to 1. Risking 1 to make 2 reward, and risking 1 to make 3 reward or whatnot. And yeah, you might know the numbers, but do you know how to tell and look at a stock and its charts and look at probability, look at previous market data on it, pricing, and the way it's moved, as well as look at the fundamentals, look at the balance sheet, and look and calculate. And you can even, just be honest with yourselves and calculate in your head, and like the probability of this going up, and where am I going to get out if I look at getting at this price, it looks like there's a support area, so you buy in and it continues to drop. Now, what's your plan? Did you have a plan before you got in or not? Or were you just gambling? And then if it does go up, where are you looking to get out? Did you have a plan on how much you're wanting to take out of it? Or were you going to scale out of it? Just like we're going to scale in it. Also, number 9, being impatient in too big a hurry to get rich. If you're looking to get rich and not have to work hard, not have to study, constantly studying the markets, constantly watching, seeing what's going on as far as politics, in the world news, everything, what the Federal Reserve's doing, interest rates, what's going on with the oils. All these are correlated into the market, and they affect the market one way or another. It just depends on what type of trading you're going to do and what stocks you're looking at trading. So with that said, they're in too big of a hurry to get rich, and so they start buying a shitload of these penny stocks, thinking that next week they're going to double their account or made X amount of returns, like some crazy number, like 40% return, 50% return. And that's just not realistic. Unrealistic expectations once again. And so with that, number 10, giving up too soon, not going back to the drawing board and studying some more and then trying again. So new traders will try all these things, dumped in $5,000, already lost half of it. Reality's starting to hit them now. And so they're like, you know what, I think I'm just going to go ahead. If I get down to my account only has 2,000 in it, I'm going to go ahead and quit, and that's it. I'm done. This just isn't for me. And the big mistake that they've done is they haven't given themselves a chance to actually be successful in trading. They basically had quit before they even started and just didn't know it, because they didn't do the homework. They didn't research. They didn't talk to other traders that have experience, look for a mentor. They just thought that they're going to read a book, take a course, and go in and start making money. And it doesn't work that way. It's hard to explain, but once you trade long enough, you'll understand why it doesn't work that way. And you'll start to understand how price moves in certain stocks, and kind of start to see why it moves. Majority of the time, the simplicity of why it's moving is either some news, they got blockchain technology, some big bank invested in them, and they got a lot of insider buying, or they had great earnings, or they missed earnings, or you know. But basically, these are the top 10 mistakes that new traders make. Is basically number one, which these aren't really in order, but quantity over quality. They don't buy good stocks that have been undervalued. They don't know even how to value things. The better you become at learning how to value things, as well as read charts and technical analysis and balance sheets, the better you become at trading. But you can't just expect to learn one tool and think you're going to master the market with just one tool in your toolbox. You need a lot of resources, and that's one of the disadvantages that the retail trader has towards trading that the hedge funds and the big banks have in their tool belt, is they have basically almost unlimited amount of resources, as far as money, data, information, speed, access, commissions. Being a retail trader, you're very limited as far as, you can get access to data, but it's going to cost you. You can get access to a good broker with fast transactions, so you can jump in and out of trades real quick and scale, but that's going to cost you commissions and ECN fees. And then you can get fundamental news like Benzinga or something like that. That's going to cost you. And so on top of starting your account and then paying for all these things, and then if you want level 2 data, Thinkorswim's the only platform I know that you can basically get it for free. Other than that, everybody else charges for it. So you have a lot of things that you're up against starting off, but it's not impossible. It's not. You have to look at the rules of the game, just like anything else, and learn what strategy is going to work within these guidelines, these rules. And one of the biggest rules that you're up against is the pattern day trading rule. The second thing that I would say is not to your advantage is that you have a small account. So more than likely you're going to be using Robinhood. So scalping is not going to be a very good strategy for that platform. Even if you do have over 25,000, the transactions take too long to go through to process, to get, put in your order, send it, then it says, orders, and then waiting for it to get completed, or, now the price has changed and you're trying to do a limit order or whatever. And so now you have to hit back. And it's just, you'll understand if you've ever done it on Robinhood versus using faster platform to trade on. So you have that against you, and if you did go to a faster platform, then you have the commissions going against you. So it's possible to make money, but you have to look at all the rules and then build your strategy according to these rules until you can get above the 25,000 called for to be able to pattern day trade. And then once you get above that, if you decide you want to learn, you want to scalp and make that part of your trading strategy, then you're going to have to look at switching brokers and now calculate how is that going to work, because now you got commissions, and so you have to take that into account. And so it is possible. For me, where I'm at currently now is that I've basically taken everything out of the accounts, the different brokers, put it back in the bank account, and said, this is what I'm going to do. I decided I was going to start streaming and showing that it is possible to grow a small account, but that you're going to have realistic expectations. You're going to have to pick quality over quantity. You're going to have some kind of strategy. You can't go by what everybody else is saying on social media. I'm sticking to stocks. If I do an option, it's because I have some kind of edge, some kind of news, or something that I know that is highly in my favor to make money off of it. And I'm not taking these big positions. I'm not starting too big. Basically, all these things that I've told you about new traders make, I'm doing the exact opposite. Being impatient, too big of a hurry to get rich. I'm not. If you see some of the stocks I have right now, I've been holding them for over a week. I think some 2 weeks, and that's just going to be the process of it. You know, that on top of that, I'm compounding. I'm adding anywhere from $100 to $200 a week, and these are the things that I'm doing to show you that you can start with a small account, have realistic expectations, realistic goals, and it'll grow. And before you know it, you'll be over the 25K. Or you can try and spend all your time and energy and resources trying to get around the PDT rule and losing money left and right, bleeding money here and there, death by 1,000 cuts. You might not take one big loss, but you continue to take small losses with a random win every once in a blue moon. Then, that year that you spent trying to get over the PDT rule, if you would have went by these deals, by these guidelines, by these rules, by these looking at these 10 mistakes that new traders make and did the exact opposite of them, then more than likely within that year, you would have been able to get, if not over the 25K, damn near close, by simply diversifying your portfolio, learning how to manage your risk, learning that it's not just about like risk versus reward, but also like just risk in general and how to manage it. As far as position sizing is another way that you look at limiting your risk. Volatility is another way of looking at risk and learn how to manage it. Also looking at the average true range for that stock. How much does it averagely move in a day? As far as swing, does it jump from, usually 20 cents, it makes 20-cent moves in a day, either 20 cents up or 20 cents down, on average, or is it $1, or is it $2? Some of these stocks, they barely make, they move just a few pennies a day, or, 2 pennies a day, and then other stocks move $1 a day, either $1 up or $1 down, or, 50 cents. And these are things that new traders don't realize coming into it. They think, I'm going to buy in. It's 50-50. It's either going to go up or it's going to go down. And that's just crazy. And so I urge you to look further into this, to not waste your time and energy trying to figure out how to get around the PDT rule. I'm sure you've hit other YouTube videos after this one looking for some answer to your issue, as far as trying to get around the PDT rule. And the best way to get around it is just to put in the time and hard work and save and compound and take on a swing trade or a long-term investment strategy in good quality stocks, and learn how to limit risk and take small position sizes. Don't expose yourself too big to any one trade to where if it goes down, it's going to take out a big portion of your account. That's not a very good risk management. And have realistic expectations. If it's that important for you to learn to be a successful trader, then you're going to have to find the patience to understand it's not going to happen overnight. It's not going to happen in a month. It's not going to happen in 2 months. It's not going to happen in 6 months. You won't know if you're a successful or even semi-successful trader until at least a year of trading, when you can look back from the day you started to that point in time and look back and see your track record and see, I've been consistent. You can see on my chart as far as my count that it's gradually went up, and what I'm saying, like, it's just going to take time. And that's probably one of the toughest things I think the new trader has to realize, is that it's going to take time. That you've been broke up to this point for how long? So what's the problem with you, being broke a little bit longer to actually learn how to trade, and take your time learning, and not just rushing into it, but giving yourself an actual chance, a shot at being successful. and that hopefully maybe one day you can make a career out of it. You know, that you don't have to work the 9 to 5. Well, at least not for somebody else. You can work the 9 to 5 for yourself. And so with that said, like I'm doing with my account, I've started a little bit, and each week I'm adding anywhere from $100 to $200 in my account, and we're compounding that, and so we're gonna see how long it takes for me to get to the 25,000 mark. But I can tell you for one thing, I'm about positive if I don't make it within a year, it'll be really close to it. I would expect, because it's a realistic expectation, that I would get at least to 20,000 within a year, if not 25. But we'll see how it goes. Keep checking in. You know, I know some of my videos are long, and I'm not asking for you to watch the whole thing through, but even just check in and say, you know, fast forward to the end and see where my account's at. Is it up or down? You know, and if it's up, then you might want to rewind it and say, okay, what's he been doing? What's going on? How was he able to consistently get, you know, 2% gains each day this week, you know, or 3% gains this week, you know? And if it's even down, it's not a bad day to look and say, okay, where did he go wrong so I don't make the same mistake? You know, a lot of times I watch traders on YouTube, and I look at things that they've done good, and I look at things they've done bad, but overall I'm looking at them and learning from their mistakes as well as their successes, so that maybe I can incorporate that into my trading to improve my trading. You know, look at everything you can use around you as far as, you know, audiobooks, Reminiscence of a Stock Operator. I listened to that. I've listened to it about 3 times now. There's so many things that you can do even when you're busy at work or whatever to help improve your trading. You know, I'm at work, I can't study charts or anything like that, but I can listen to an audiobook. I can listen to interviews on Chat with Traders. I can, you know, there's just different things that's possible for you to be able to study, you know, throughout, but it's going to take some hard work. It's not going to be easy. And it's going to take some time, more importantly, some time and patience. And with that said, I'm going to go ahead and wrap it up. Thank you for watching this video. If you have any questions or any suggestions, just leave them in the comment section below, and I will see you all tomorrow when market opens, and we will look to see where the count is. I wasn't able to meet my goal of hitting 2,000 this week. I got close. I was a little under $100 shy from hitting it, or a little over $100 shy of hitting it. Actually, I think it was like about 100. I missed it by 115. That was the market had a pullback, which was expected. The overall market on the SPY, and so I'm looking for it to start to continue its trend up this week. And I expect by the end of the week that I've hit my goal of 2,000. So with that said, I'm gonna go ahead and shut it down. My apologies for the video being so long, but y'all have a good evening, and I'll see y'all tomorrow morning. Peace.